Hi everyone, this is a screencast for Independent Colleges Dublin for ACCA P6 IRE Advanced Taxation. We're using the FA 2013 legislation and indeed the BPP text referring to exams in 2014. Now, within this short screencast, this very basic screencast, I'm looking to introduce capital acquisitions tax, CAT. Now, this is an important area for you because looking back over past exams, this is an area that your examiner, John Morrison, examines on a regular basis. Certainly, just about every exam will have a CAT element. So, albeit for the fact that this screencast is at a basic level, it's important for you to get a feel for the basic mechanics of this tax, because this will lead on to more complex areas, perhaps CAT reliefs, etc. So I think having a grip on the fundamentals will help you tremendously. And I'm hoping that this screencast will do that for you. Okay, so moving on, in terms of a sort of a starting point, really, I'd refer you to BPP text chapter 17 if you're using the BPP material. And if you're not, I think the screencast will still be able to help you a little bit. So in terms of an introduction, what is CAT? Well, essentially CAT is a tax on the transfer of capital or property from one person to the other. Okay. Now, what I mean by that is that essentially the wealth of one person, this person here on the left-hand side, is being depleted, and the wealth of another individual on the right-hand side is being increased. So we have a situation where we have a disponer, i.e. a giver, and then a donee or receiver or recipient. And the big issue for you within CAT is really to establish what is the taxable value of that transfer or of capital or property. In other words, what can you apply the CAT rate of 33% to? And essentially, really, that's where John Morrison is going to attack this area. He's looking to see whether or not you can become familiar enough with the sort of the technical rules to run from really the sort of the MV of the property, which essentially will be given in the question, and the taxable value. So in between those two different areas, there are a lot of tricks that he can play on you. So it's about being able to just work out that taxable value. Okay. I draw your attention also to just the fact that the terminology is a little bit unusual. You have on the left-hand side, as I said, the disponer, so the giver. You also have the donee on the right-hand side. And I think that's something that within CAT that, on occasion perhaps puts students off. It's terminology that they're not familiar with. It's, coming up in questions. Not only do they have to sort of answer the questions, they have to decipher the terminology. So my advice on that front is really to, study the definitions carefully. And we'll be coming on to a set of other definitions in a moment. But really try and immerse yourself in the subject. The more practice that you have, the easier it will get. And to a large extent, there aren't really that many technical terms that are sort of ones that you won't be able to understand at all. They're fairly straightforward, as the ones that you see on this slide are. We're just talking about a giver and a recipient, essentially. So nothing to worry about there. Just keep doing the questions. Okay, so moving on from here. What is CAT and really when is it payable? Well, we talked about this issue of a depletion of wealth for the disponer or the giver, and really there's two main areas that you would need to look at. And one of them is the obvious one, where you have someone who dies and passes on wealth to the next generation, and as you would expect at that point, CAT is payable. But in addition to that, unusually, you could have a situation where CAT is due in lifetime on gifts. In other words, gifts perhaps for no value at all, or perhaps even gifts at undervalue. So just be careful that you're aware that CAT can impact not only on death, but also in lifetime. And again, I'll refer you back to the my previous point about just this idea that really CAT is about what's the taxable benefit. Yeah, I can see the sort of market value of the property or the capital at the date of the transfer, but really it's getting that taxable benefit that's important to you, and really the tricks between those two different areas. Once we have that taxable benefit, we apply a tax rate of 33%. Okay, so in terms of something slightly random here, here's one trick that will be played between, the sort of market value given in the question and also that taxable value. And you'll see the screen, you'll think, well, that's a fairly sort of random date just to appear out of nowhere. And I'm not going to give you any detail on that right now. I'm just going to make you think that really there's something to do with this date that is relevant in tying up or clarifying that taxable value. And really that's just the date that we need to remember. Okay, 5th of December 1991. A little bit random, but it's a date certainly that you need to remember. So more of that a little bit later. Okay. So moving on from here, I talked about definitions and new terminology, and really sort of my experience of students coming to me and saying, well, I don't really understand what a life interest is, or what does remainder man mean, etc. And really, for the purposes of this screencast, I'll just give you a quick spin on one or two of these. But as I say, my advice is just to pore over the questions. The more you do, and really the more sort of quality time that you give to CAT in your studies, really the better you're going to get. So let's just pick out one or two of these. Well, first one here, we've got something called an absolute interest. Now, essentially what I mean by that is really that an individual, let's just say we have a transfer of property or a transfer of capital. If someone transfers a property and transfers with it, in effect, their sort of absolute interest. In effect, what they're doing is they're saying that I'm giving full ownership of the property to another person. So really that person can do with the property as they will because they own it. Okay. Now, in addition to that, draw your attention perhaps to, let's say, life interest. Okay, a life interest. Now, that sort of, it sort of does what it says on the tin. In essence, what we're saying with that is that an individual has an interest. In other words, he or she can benefit from the property for their life. But once they die, it's transferred on to another person. And in fact, it's transferred on to what we call the remainder man. Yeah. So we could have a situation where someone transfers capital or transfers property and gives person A a life interest in the property so that they can benefit from it. Perhaps it may be that the benefit could be that they can live in a property. Yeah, until they die. It could be perhaps a husband in his will bequeathing this to his wife. So in other words, he could say that his wife can live in the property until she dies, but then it's transferred to his son or daughter. So really these terms here sort of center around this idea of really how much of the sort of interest in the capital or property that is being transferred is actually given to the other person. And it doesn't necessarily have to be that the individual is given outright ownership. They could just be given an interest, perhaps a life interest, or even what we call a limited interest. In other words, I could give someone an interest in this particular property for 5 years. And as a result of that, there would be specific rules in order to calculate the taxable benefit. So I draw your attention to really the different sort of nuances and the different sort of definitions. But what I wouldn't do is to say to you, well, on your first, second, or third read, if you don't understand them, then you're in big trouble. I don't think that at all. I think that, this issue with CAT and indeed P6 across the board is just a question of just picking up what you can as you go through your studies. But don't be overly concerned in the first instance, the first night you read, or even the third night you read these definitions. Don't be overly concerned about that. Just keep plodding on with it. Okay, just last one here that I'll draw your attention to is just the residue. And the residue really is what we're saying is the residue of an estate. So let's say, for example, someone has an estate of £10 million. Once all the sort of claims or indeed legacies are taken off, XYZ to Joe, ABC to Mary, etc., etc. Once all of those have been taken off, the residue perhaps goes to Tommy. Yeah, so the residue estate is really what's left over after all claims and indeed legacy. A legacy just simply means a sort of bequest to a person. I give you this in my will. So that's all that residue means. Okay, so moving on from here. We talked about taxable value or indeed taxable benefits. So, how do we go about calculating taxable value or taxable benefit? Well, one of the key things that's important is this idea of really the relationship between the disponer, remember that's the giver, yeah, and the recipient or the donee. Because what the revenue do, which is helpful to us, is they provide us with a sort of a free pay amount. It's as if, okay, you're transferring this value of property over to this person. Okay, well, that's fine. But listen, we'll give you a little bit of help. What we'll do is we'll allow you to deduct from the MV essentially of that property a certain amount depending upon the relationship between you and that person. Now, remember I mentioned about the date, i.e. the 5th of December. Well, that date's going to come into play in a moment, and I'll explain it when we get through the next set of slides. But essentially what I want you to remember about thresholds or group thresholds, and these are given in the tables, by the way, over the items over the next 3 slides, is that what we're essentially going to pay CAT on is really the excess over the relevant group threshold. So depending upon the relationship between the two people, we've got to say, perhaps by looking at our tables, or perhaps we remember the numbers, okay, the relationship is, father-son, and that's group 1. Therefore, the value of the threshold is 225K. So really the excess, if there is one, over and above that level is really what's going to be taxable for CAT purposes. Okay, so that may lose a little bit in translation, but as I say throughout all of these screencasts, I think practice makes perfect. Okay, so let's have a quick look at group 1. Before we do that, just a basic calculation. This is what I've really been referring to before we go on to the thresholds. Apologies for that. We have a basic calculation here. So here we have some sort of benefit being transferred from one person to the other. So in other words, we have a transfer of property from one person to the other of £35,000. That's in essence what we're saying the market value is. And in this particular case, we don't know a lot about group thresholds at the moment, but in this particular case, this is based on FA12, by the way. In this particular case, the group threshold for this person, for this transfer, was 33,500. Okay, that's effectively the middle group. Okay, group 2. Now, as a result of a previous transfer, in other words, a previous transfer was made after the 5th of December 1991. So that's I mentioned to you the date, yeah, and the date is relevant because of the fact that this particular transfer here, in other words, this transfer of value, this gift, shall we say, was made in our current year. Okay, so we're looking to establish what's the taxable value on this gift. Okay, but what we've got to do is say, well, listen, the revenue are going to give us some help. The relationship between these two people is such that the group threshold, group 2, is 33,500. But what we have to deduct from that group threshold are any benefits within this group, not necessarily between these two people, but within this group since the 5th of December 1991. So you'll see how that date comes into play. And really what we're looking to do within CAT questions, really as quickly as we can, is sort of establish what is the group threshold that applies. And in addition to that, what element of it has been used up since the 5th of December 1991. So you can see how the sort of the picture is building up here. You know, in the first instance, we've got CAT. It looks like it's a transfer from one to t'other. Second thing we need to do within the questions is, okay, well, what's the relationship between those two people to establish what the group threshold is? And then really the third thing that we need to do is we need to remember that sort of random date. That doesn't change, but we've got to remember that date because we've got to look in the question to see, you know, has that group threshold or any of it been used up within that group? Remember, it's not necessarily between those two people, but within that group since the 5th of December 1991. Okay, so you can see how things are sort of coming together for us now in terms of a basic calculation. I am coming onto the groups in one moment, but you can see how you know, a simple computation is made up, and also you can see that, you know, once we get that taxable value, obviously down below here we're looking to apply the CAT rate at 33%. Okay. So moving on from here, I am actually coming to the thresholds now. My apologies for my slip up earlier on. Group 1, okay. Now, I'm not going to go through the detail of the narrative here in each of these groups. What I'm going to tell you is this. There's 3 groups, okay? So for me, there's, you know, 3 types of relationships between the disponer, the giver, and the recipient or the donee. Now, this group 1 looks to be quite an important group because the value is so high. So in a sense, what we're saying is that we can have, you know, transfers or gifts or inheritances in effect up to that value before we pay any CAT on them. And the classic one here is really, you know, a child from a parent. So in other words, we have the parent doing the giving, the parent's the disponer. We have the child as the donee or the receiver. So really, if we see a transfer of 500,000 euros or €1 million, what we can say is, well, you know, part of that is definitely going to be covered unless there have been similar transfers in this group, in the whole group, since the 5th of December 1991. Okay, so moving on from here, group 2. Okay, I'll draw your attention maybe to this third one here. There's a brother and sister. Yeah, so this is relates to transfers between perhaps a brother and a sister, and again works in exactly the same way. You know, we could have the brother being the disponer, i.e. the giver, the sister being the donee or the receiver, and really what we're looking to do is to deduct that value of 30100. That is at current FA 2013 rates. Really deduct that from the value of any gift or any transfer of value, okay, or indeed inheritance. Again, bear in mind, we're looking back to the 5th of December 1991, and John Morrison will do that in the exam. He won't give it to you straight on. He won't simply say, you know, 30,100 is all available. He won't do that at all. He'll definitely give you something that is a past transfer, and you're going to have to deduct that before you apply the threshold. Okay, last one here, reasonably simple. It's just all other persons at 15075. Okay, all of the persons outside the groups that I've just described. Okay, so moving on from here, I'm stuck for a little bit of room here. My apologies. Really, what you can see is, excuse me. So far, this is just a cut and paste of the same item that we saw a couple of slides back. Again, just draw your attention to the fact that this cut and paste is from the FA12 text, so that's slightly out in terms of the value of the Group 2 threshold. But essentially what we have so far is this. We've got transfers from one person to the other, disponer to recipient. We need to establish what's the relationship between those two people. And the reason that we do that is we've got to find what the group threshold is. Once we find the group threshold, then we've got to say, well, okay, have there been any other benefits or indeed transfers within that same group since the 5th of the 12th, 1991? So those are the key questions for us. And, you know, when you approach a CAT question, you know, those are the things that he's going to be testing. Okay, can you establish the answers to these questions, and can you do them quickly? And do bear in mind that, this is a complex area for, every P6 student. It's pretty easy to make mistakes in this area, but, the bottom line is that really with a CAT question, or indeed any other P6 question, if we can get 50% of the numbers in the right place at the right value, then we have a fair chance on a computational question of passing the question. So what I didn't say is we need to get 100% of the numbers at the right value in the right place, because we don't need to do that. So really do have that attitude when you're doing the questions at home. You're bound to make mistakes, and you quite possibly make the same mistakes over and over again. So don't be worried about that. That's highly likely to be exactly what your predecessors or people that have passed this exam have done, certainly in this area. This is a tricky little tax to get a grip on. So, be quite happy to make mistakes, but just keep at it. Okay, so in terms of a couple of tricks in the area of the thresholds, I picked out two for you here. Because we're just trying to cover the basics within this screencast, is really what I call, or what the BPP text calls, special relationships. And I draw your attention to page 223 and 224 of the BPP text for FA 2013 in this respect. And really the first trick relates to spouses. In other words, just a couple of curveballs in the area of transfers from spouses. And essentially, broad rule is up the top here, as we see, is that the sort of interspouse exemption does apply in the first instance. So basically, if you receive a benefit from a spouse, then as far as the revenue concerned, that's completely exempt from CAT. But as with all tax examiners, what John Morrison is likely to do is to possibly play around with this area. Now, before I mention to you the key trick, just bear in mind no requirement under CAT legislation for the couple to be living together to benefit from the interspouse exemption. But watch out for this area of this sort of couples that are sort of perhaps heading towards a divorce. In the instance where there's a formal divorce agreement which is perhaps about to be put in play, then certainly the exemption would still apply up to that point. But after the formal divorce agreement, then the exemption will not apply. So just really something that you need to remember, and also just draw your attention to the fact that slightly different rules here than for example, for CGT or IT purposes. Okay, the next one here in terms of a special relationship relates to a sort of a widowed person. Again, page 223, 224 of the text, the BPP text. Well, what we're saying here is fairly straightforward, actually. We're saying that we have a widowed person, a widowed spouse, let's say, and what happens is that we take the same group threshold for this person as their deceased spouse. In other words, a normal situation for a daughter-in-law, as you'll see from the middle of the screen there, normal situation is that a daughter-in-law would be under group 3. Okay, you can check that back and check your text just to confirm that, but that's the normal situation for a daughter-in-law, even though unusually it's quite a sort of a close relationship, as you'd imagine, between, let's say, a daughter-in-law and a father-in-law, mother-in-law, although maybe it's not. But in this particular case, because of the situation, in other words, because of the unfortunate event of the deceased spouse, her spouse dying, his spouse dying, we have a situation where the daughter-in-law, although the normal group threshold is the 15K, that in effect, if her husband dies, she will take on the group 1 threshold. In other words, she will take on his threshold for benefits from her father-in-law or indeed mother-in-law. So in essence, I guess the revenue are giving the daughter-in-law a break, understandably, in view of the circumstances. So rather than sitting in her own group at a low level of 15K or thereabouts, she's allowed to take on a higher group threshold, i.e. Group 1, but only in relation to benefits from her father-in-law or mother-in-law. Okay, so in effect, she becomes him. Okay, so moving on from this area, a couple of worked examples. Again, this will only be relevant if you're using the BPP text, and so you can refer to page 225 on the particular issues that I've discussed so far. Next point, valuation date. Well, essentially, valuation date, it's not an overly complex area because for the most part, really, the valuation date will be given in the question. I guess the thing that you would need to just be careful of is just this idea of, certainly for a gift, the valuation date being only relevant when the individual becomes beneficially entitled to the asset. In other words, where they hold an interest in the asset. So just watch out for gifts. It may well be that John Morrison plays with this area of dates, but essentially we're looking for a beneficial interest being available to the receiver or the donee, and that's really our valuation date. I don't see this as a big or very, very important area of CAT, to be honest, because I think for the most part the valuation date will drop out, okay, both for inheritances and for gifts. Okay, so in terms of our sort of broad summary so far, again, I've been referring back to this cut and paste element from the FA 2012 text, as mentioned. Just watch out for that slightly different figure there for the group threshold value. Really, what we have so far is, some sort of benefit or some sort of capital being transferred. Okay, we have establish some sort of group threshold. In this case, just for our simple example, we've said that it's Group 2. Okay. We've also said that in this instance, it looks as if, per the question, we don't actually have the question, but per the question, it looks as if, okay, we've got the group organized. We know it's Group 2, that's the FA12 value, but since the 5th of April 2000, 5th of December 2000, or 1991, I told you that people can get confused. Since that date, we have a £20,000 benefit or €20,000 benefit being received by this particular individual. And really, as a result of that, we have a situation where we have to deduct that benefit that was received from the available group threshold, and that reduces the amount that we're able to deduct from the value of the current benefit, leaving a taxable value of 21,500. Okay, so what this slide is saying is, okay, I understand that so far, but is there any other help that we can get? And certainly there is a little bit more help that the revenue provide, in essence, to reduce the value of the taxable benefit. And the sorts of things that you would expect to be deducting are things like liabilities, expenses, and indeed consideration. Now, it's a little bit like what we covered within the intro to capital gains tax in an earlier screencast, in the sense that these items are just really deducted from the market value. Okay, so if in doubt, I guess a rule of thumb might be that you deduct these items if you are in doubt. You've got a pretty good chance of getting them right. More often than not, if you see items linked around the area of a transfer of property or transfer of capital, more often than not, they can be deducted. So, if you're in doubt, I would certainly take a punt on deducting these items. And really what they do, or what they give us, is what we call the sort of encumbrance-free value. And really all that means is just the value that we have as our starting point when we then come to deduct, the group thresholds, or indeed perhaps CAT reliefs, etc. Okay, so watch out for items that are given in the question that are sort of that look as if they're deductible, because the chances are that most of them will be deductible, and they'll certainly help you to reduce the taxable amount, and really that's what you want for the taxpayer, of course. Okay, so one for the road, just this small gift exemption, and that's very simply just an amount of €3,000 from each disponer that can be deducted. So again, there's a simple deduction from items that you will see within the question that again reduce our value that is taxable. Okay, so in terms of a summary here on CAT. Really, CAT is about transfers of capital or property from one person to the other. The person receiving the property picks up the tab, in other words, picks up the CAT bill. So really what they're looking to do once they have knowledge of the market value of what they're about to receive, I guess what they're looking to do is to try and find ways to reduce that market value. Now, the revenue does give quite a bit of help, in fact, and those group thresholds are key. So what they ask is really, what's the relationship between the disponer, the giver, and the person doing the receiving, or the donee? Okay, what's the relationship? We've got to slot the persons into a group, either group 1, 2, or 3. And in addition to that, you'll remember we had just a random date of the 5th of December 1991, get it right. What we have to do within the questions is not only to find the relationship between the two people, but then to look back quite a long way, really, and say, okay, well, I have the group threshold, it's 225,000 for group 1, but within the group, all of the group, not just between the two people who are doing this particular transaction, what is the value of transfers of capital historically from the 5th of December 1991 onwards? And if that has a value, and I suspect in your exam there will be something that of that nature, then the threshold needs to be reduced first before we apply it to the market value of the asset. So watch out for that. We can just get some easy marks for dealing with that. And if you think about it, it's not too complex. Just looking back, key date, what else has happened, let's deduct it, then let's apply the threshold. We might even get a mark even if we've got the threshold wrong, if you see what I mean. Okay, so moving on from that, really, there are one or two other deductions we can make, things like consideration. In other words, the person has paid something to the disponer for the particular capital, or perhaps some expenses, maybe funeral expenses if it's an estate on death. And possibly liabilities like a mortgage, for example. In other words, if a property is transferred and there's a mortgage attached to it, okay, in effect, we're looking at the net value. Okay, so I draw your attention to one or two of the other tricks, for example, where John Morrison may fiddle around with the group thresholds. In other words, let's say, for example, in relation to a widower, where we have, I think we had a daughter-in-law who, in effect, as a result of the unfortunate death of her partner, is going to take on her partner's group threshold, which is obviously much higher than hers. She's in group 3, he's in group 1. So revenue giving a little bit of help, thankfully, to that daughter-in-law, but only in relation to benefits from her mother-in-law or father-in-law. Okay, so hopefully that's been some help to you in relation to a very basic introduction to CAT, and watch out for further CAT screencasts that I'll be uploading to YouTube, and indeed good luck with your studies.